Hey, welcome back to the training. So in this video, we're going to be talking about the fundamentals, the underlying factors which determine price on the market, on the stock that you're looking at, really of everything in the market. So what are fundamentals? The fundamentals are the underlying factors that are considered to determine the health and performance potential of a company, security, or economy. So these factors are used primarily in fundamental analysis, used for evaluating a security's intrinsic or actual value, not what it's going to be worth in the future, or if it gains a larger market share in the future, maybe what it might be worth in the future, but what it is worth now based on what's on the books. So all present and forecasted fundamentals are priced into the value of an asset. Whenever we have earnings reports give us things like the revenue of a company, how it performed, how well its debt to equity is, things like this. And they also provide what they call guidance. What do they think the company will earn by next quarter? How is it performing from quarter to quarter? So all of these different types of factors are priced in. So I said that it's the actual value, but companies also provide data to show how their growth is as a company. So that the actual numbers of that growth are priced in to assume that if that growth is maintained, that by next quarter, the company should be making this much money, right? So all fundamentals, whether it's present or forecasted, the guidance of what they expect is coming next quarter is priced in to the value of an asset. So something else to keep in mind is that all financial instruments are forecasting models that are based on the value of these forecasting models of value based on these different key factors. So the different fundamentals that companies will look at are a handful of financial statements like the balance sheet, the income statement, cash flow statement. They provide a wealth of information about a company's financial health and performance. The balance sheet shows the company's assets, liabilities, shareholder equity. Income statement provides information of the company's revenues, expense, profits, or losses over a certain period. Cash flow will detail the company's cash inflows and outflows. Earnings and revenues, analysts will look at earnings trends and future earnings projections, what I was just talking about, the guidance, to assess a company's profitability. We look at things like profit margin, return on equity, return on assets. We look at debt to equity ratios and a quick ratio as well. So the quick ratio measures the ability of a business to pay its debts based on everything that has all of its assets. If it had to convert it into cash, how quickly could it pay its debts, and how easily? Would the company become insolvent, or would it still have plenty of cash left over, right? So a quick ratio greater than 1 is typically a good ratio. Something just to keep in mind. As for the market as a whole, we look at economic indicators. We look at things like the gross domestic product, measures the total value of goods and services produced by the U.S. economy over a specific period of time, for example. We look at things like the unemployment rate. If unemployment starts to go really high, then people's savings probably go way down. And if people have less in their savings, they're probably buying less. If they're buying less, then the value of goods must go down. The value of market assets will probably go down too, because perhaps all these unemployed people need to start selling pieces of their 401k to get by. We also look at things like the Consumer Price Index. CPI measures inflation, or the Producer Price Index, also a measure of inflation on the back end. It's the consumer side versus the producer side. When inflation goes up, it also has a direct correlation to the way interest rates are handled, whether they're we have rate hikes or rate cuts. So in 2022, 2023, we had rate hikes, and now in 2024, so far we have had no hikes, no cuts, but they are projecting that maybe by the end of the year we will see some cuts. So it all has to do, though, with these kinds of this kind of data. How is the unemployment? How is the inflation on the consumer side? How is inflation on the producer side? If inflation stays high and unemployment stays low, then the Fed will not cut rates, because cutting rates would cause prices to go up. It would allow people to buy more and more and more, and that would only make it harder for people to, live. So we really want to keep uh, interest rates higher when inflation is higher, so that hopefully, unfortunately, people will buy less and that inflation will come back down and kind of get back to an equilibrium. So we also look at things like retail sales, manufacturing data, and like I was just talking about, interest rate decisions are really key. Markets like cheap money. Markets really we all like cheap money. When you go to buy a house, you would definitely prefer to buy a house with a 2% mortgage rate than a 8% mortgage rate, right? And markets are no different. Companies are no different. Companies love to borrow money, and the more money they can borrow, the more they can invest in their different ventures, the more they can grow their company. But when interest rates are higher, they borrow less, they invest less in their companies. So markets like interest rates that are lower or that are falling, because it means that there's cheaper money available and that there's more to be invested into assets, into the company, so that they can grow things for the future. Another really important indicator is the housing market. How are new home sales, building permits, housing starts? A strong housing market typically reflects a strong economy. So when housing starts, home sales, building permits are all lower, it means that less people are buying real estate or feeling comfortable about making such big purchases. Not generally a good sign for the economy. Maybe they're waiting for prices to fall because things are expensive, inflation is high, and maybe they're waiting for Fed to drop rates. But that can be a catch-22, because if the Fed drops rates, then obviously more people will be interested in buying houses. More people are interested in buying houses, the higher prices are likely to go. So it's a never-ending cycle of managing inflation and growth. And we look at all of these different factors to determine, how is the economy doing? How is a particular stock doing? So yeah, the economic data can affect the market sentiment. Positive or negative data can cause the market to go higher or lower, or simply data that was misestimated. So a lot of times you'll hear, the estimate for this particular number, inflation, was supposed to be 2.5, but it ended up being 3.5. So when they get their estimate of what it's wrong, we need to price in that difference. Up until that moment, they were thinking the number was going to be this, and the market was reflecting that expectation. But the second that the number that they were expecting to have been priced into the data is different, well, price has to reflect that as well. So, monetary policy expectations can influence it. Sector-specific impact. For example, high oil prices might change the way the energy market will respond. The value of the dollar. Having a strong currency is also important, especially for the U.S. economy. And a weakening dollar can be have a negative impact on the U.S. stock market. When the dollar is worth less, then we can't spend it in investments abroad as well, but more money can come from outside the country. So this can affect the market. We also have long-term trends versus short-term noise. Some traders use these economic reports for short-term trading opportunities, maybe particularly around the Fed announcements or inflation data, where long-term investors will typically build this economic data into their long-term investment strategy. They'll buy different things, different assets in different sectors, maybe gold or energy, whatever it is, to hedge against the things that they think will be a problem in the future. So understanding these different Economic indicators, their potential impact on the market is crucial for making informed decisions. However, let me just say that using the momentum options trading strategy, you will rarely, if ever, make decisions based upon this information. I absolutely track this information. I like to, you know, absorb it, understand how it might impact the market, the stocks that I'm looking at in the future, so that I can set the right expectations for the trades that I'm planning to take. But at Momentum Options, we really believe that price is all that matters because all factors, all economic data, absolutely everything gets priced in. And you can only profit when price is moving in our favor when we get into a trade. And you only want to be in a trade when it's making you money. So we get into trades because things are happening. We take profit when our targets are achieved. And when trends break, we get out. I typically look at news after, especially while I'm trading. I don't really care why the candle just shot up. All I need to do is follow my trading plan. I got in because I was expecting it to shoot up. Something happened. Now it shot up. All I need to know is I need to take my profit. And if the trend breaks, I need to close my trade. There's no speculation. There's no wondering what's going on. We're only getting in because something according to our strategy has happened. And then after that, we're just following a trading plan. So we're not making, high stress emotional decisions because the Fed just changed interest rates and that's going to be some big deal. And, how's the market going to move? Like people get so worked up over these kinds of factors. But for me, it's just like, yeah, that happened and I'm trading. Like we're just making money on the thing that's moving. And it was moving because our strategy said it was going to move. Price is all that mattered. Oh, and the news happened. It just happened to align with whatever we were doing. And that happens so often. So often that we'll get a signal on a trade, maybe a swing trade, maybe a day trade, and then the news will come. Because institutional investors generally know all of these things well before us. They have inside information. It's just facts. You may not like the fact, but they do. All these institutional investors get access to this financial information, the economic data. They have programs that sort through this data and have very specific expectations using hundreds of people's research, thousands of people's research to determine what these numbers should be, and when they're different, how will that affect things? Hundreds of people thousands of people do all these calculations to figure these out for these hedge funds, but it really doesn't apply to us because, like I said, they were already pricing that in ahead of time, and often price lets us know. I mean, it's not uncommon that, say, before earnings, our stock, like maybe the day before, Amazon, this 2 weeks ago, Amazon signals on Swing Trader the day before earnings, and then pop, it jumps because it was being priced in. The institutional traders already had a good expectation of what that earnings report was going to say. Price started to break resistance. We got a breakout signal. You got in, and it popped on earnings because they kind of already knew. So in my trading, price is all that matters. I assume that everything is being priced in because the big guys, these institutional investors, that's what their job is. Our job is to flow with the momentum, follow the price. Their job is to try to make wild predictions based on this different data and hedge every single investment of every single stock, of every single option, all the way up and down the board. We don't do that. So since we don't do that, let's just focus on price, what it is doing. We get into our trade, we take profit, we get out. That's it. Let's not complicate things too much by trying to figure out how the economy is going to do in the next 2 or 3 years, or who the next president is going to be, or whatever it is. Like all of these things matter to the market, but trying to speculate, I mean, as retail traders, in my opinion, is gambling because we just don't have enough influence for it to matter. So since we don't, all we really need to do is follow where price is going and lock in profit from that movement. Okay, so that's it for this section. In the next section, we're going to be talking about the momentum options methodology. I was already just kind of getting to a little bit of it just now by saying price is all that matters, and all we really need to do is flow with the momentum. So we'll get into exactly what that means and how we're going to be doing it in the next couple of sections. So I will see you there.